This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 15, 2026, and this is the London session. Now, let's get into it. Fear is at its lowest ebb in months, yet the market cap is climbing. Bitcoin is holding steady near $64,000, but the leverage that usually powers these rallies has vanished. Welcome to ShadowQuant Crypto Edition, London session. Today, we're dissecting a market caught in a structural squeeze. Retail is terrified, but smart money is quietly rotating into a very specific corner of the ecosystem.
That's the headline right there. We are seeing a complete bifurcation. The fear and greed index is sitting at a historic low of 14 out of 100, signaling extreme capitulation among retail traders. Yet despite that panic, the total market cap has expanded by 3% in 24 hours. That is not noise, that is a structural divergence. Institutions are not fleeing crypto, they are fleeing Bitcoin futures, and they are moving directly into tokenization infrastructure and high-beta altcoins. The game has changed from Bitcoin goes up to where is the liquidity going now? And the answer is clearly not spot Bitcoin.
And let's be clear about what that fear looks like on the ground. We are tracking a 7-day trend that started at 12 and climbed to 14. Most people see extreme fear and assume the bleeding is continuing. But when you pair that absolute dread with a 32% increase in 24-hour volume exceeding $75 billion, you realize the sellers have been absorbed. The crowd is waiting for the other shoe to drop, but the institutional bid is stepping in to catch it. This is a classic sentiment trap. Everyone is positioned for a crash, which means there is nobody left to sell.
It's not just absorption pulse, it's active migration. Look at the flows. Bitcoin futures demand has collapsed to 2024 lows. That is a vacuum. At the same time, Chainlink is up 5.6% and Ethereum is up 5.4%. The capital isn't disappearing, it's hopping tracks. It's leaving the speculative leverage of Bitcoin and pouring into the utility layer, specifically tokenization. We saw TD Securities recently call the NYSE tokenization an institutional turning point. That headline didn't just move sentiment, it moved trillions in consideration. The flow is explicit. Exit the leverage void, enter the compliance-ready smart contract platforms.
And that flow is writing a very ugly chart for Bitcoin's short-term prospects. Bitcoin is sitting at $64,802. On the surface, that's a green day with a plus 3.64% change, but look underneath. The futures demand is dry. There is no fuel behind this price. Contrast that with Ethereum at $1,876.99. Ethereum is showing true relative strength, expanding its dominance as Bitcoin shrinks. We are seeing a technical leadership switch. If you're looking at Bitcoin spot as a buy signal, you're ignoring the fact that the derivative market has already voted no. The structure is hollow.
Hollow might be too gentle a word, Grid. Let's talk about the fragility here. You're talking about leadership switches while the SIBO VIX has crept up to 17.16. We are seeing equity market anxiety bleed into crypto risk appetite. And don't forget the geopolitical friction. We've got Iranian crypto outflows spiking 700% following recent geopolitical strikes. That is not a stable environment. It's a stress test. When you combine a liquidity vacuum in Bitcoin futures with global macro uncertainty, you aren't looking at a leadership switch. You're looking at a spark waiting for a powder keg. The fact that altcoins are rallying right now feels less like smart money and more like hot money trying to escape a sinking ship before the water rises.
Let's zoom in on that tension. Bitcoin is essentially flatlining on leverage while the broader market rallies. Why is Bitcoin holding at $64,802 if the futures market is empty?
Because spot liquidity is thick enough to prevent a freefall but thin enough to offer no upside. Bitcoin is trading between a 24-hour low of $62,442 and a high of $65,104. It's oscillating in a tight range. The lack of futures means there's no short squeeze potential to push it higher. It's a range-bound value trap. Meanwhile, Ethereum at 1,876.99 is breaking out of consolidation. The technical energy is elsewhere.
Exactly. The institutional desks I track aren't touching Bitcoin spot anymore unless they need it for collateral. They are deploying capital into Chainlink and Ethereum because those protocols have actual revenue streams and tokenization narratives attached to them. Bitfinex is reviving tokenized bonds to target crypto-native yield seekers. That is a permanent shift in how capital views these assets. It's not gambling anymore, it's yield generation. That's why Chainlink is up 5.6% to $8.37. It's playing the hand of regulation and utility, which is currently safer than holding a coin with collapsing futures demand.
But at what cost? You're describing a scenario where the base layer is rotting. If Bitcoin dominance continues to contract from 56.34%, it's not because Bitcoin is succeeding. It's because investors are abandoning the entire category's main hedge. When the VIX spikes further, or when that Iranian outflow data triggers regulatory crackdowns, which seems likely given the sheer volume of movement, those yield-seeking tokens in Ethereum and Chainlink will drop faster than Bitcoin ever did. The beta is too high. You're buying the dip in alts while the anchor is being cut loose.
See, that's the contrarian argument I'm struggling to reconcile with the raw sentiment data. If the risk was so imminent and catastrophic, wouldn't we see volume drying up? We have $75 billion in volume. People are still participating. The fear and greed index is at 14, yes, but the 24-hour change in market cap is positive. The crowd is scared, sure, but they aren't leaving. They are just confused, and confusion is where profit is made. The rotten base argument assumes a sudden collapse, but the data shows a slow, grinding rotation. Retail is staying alive, just in smaller caps. Let's pivot to that rotation. If Bitcoin is lagging, what is leading the charge? Ethereum is showing significant momentum.
Ethereum is the technical standout here, $1,876.99. It's not just up, it's outpacing Bitcoin by nearly 2 percentage points in a single day. The chart shows a clean expansion against the Bitcoin/Ethereum pair. We aren't seeing the choppy indecision we see in Bitcoin. We see momentum. If Ethereum can hold above its current support levels, it validates the rotation thesis. But if it rejects, the entire alt-season narrative collapses instantly. The risk/reward on Ethereum is currently superior to Bitcoin simply because the leverage is cleaner.
And the catalyst is clearer too. The US Senate housing bill, including a CBDC ban, is a massive tailwind for Ethereum's smart contract utility. It removes the existential threat of state-controlled digital currency, pushing capital back into decentralized networks. Plus, the Monad bridge adding $5 billion in Bitcoin-backed liquidity is flowing through these ecosystems. It's not just speculation, it's infrastructure buildup. The money is flowing into the rails, not the car.
Or it's flowing into the rails because the road ahead is blocked. The CBDC ban sounds great, but let's not forget the broader context. We have U.S. authorities seeking to recover $327,000 in stablecoins from romance fraud schemes. Enforcement is tightening everywhere, and Core Scientific turned lower after disappointing Q4 results. The infrastructure play has earnings risk. Just because you're investing in rails doesn't mean the construction workers are getting paid. The VIX is rising. The regulatory net is closing. These tokens are rallying on hope, not fundamentals.
Core Scientific is down, but the broader infrastructure narrative is up. Let's look at Solana. Solana is at $78.02, up 3.97%. Is this part of the same rotation, or is it speculative excess?
It's speculative excess with a backbone. Solana is capturing the high beta flow from traders who are avoiding Bitcoin futures. It's the playground for the capital that fled the leverage vacuum. The Monad liquidity news is specifically tied to EVM-compatible chains, and Solana is the fastest horse in that race. The flow is undeniable. Traders want speed and low fees, and they are willing to pay a premium for it right now.
Technically, Solana is testing local highs at $78.02. It's close to the 24-hour high of $78.43. If it breaks that, we see acceleration. But remember, grid trades levels, not narratives. The volume supports the move, but the proximity to the high means it's extended. A pullback to $74.86, the 24-hour low, is a valid risk if the broader market cools. It's a momentum trade, not a value hold.
It's a momentum trade in a bubble. 700% spikes in outflows from sanctioned regions don't create legitimate markets, they create honeypots. When regulators decide to crack down on these high-throughput chains, Solana gets crushed harder than anything else. The speed narrative evaporates overnight. Don't confuse velocity with sustainability.
Let's talk about Link. Chainlink is up 5.6% to $8.37. This feels like the strongest conviction play in the room. Why?
Because it's the bridge. TD Securities calling NYSE tokenization an institutional turning point is the kind of validation that moves Wall Street money. Chainlink is the Oracle network that makes that tokenization possible. It's not just a token, it's the plumbing. The flow is coming from institutions who used to sit on cash, now allocating to Chainlink because it has real-world use cases tied to traditional finance. The volume backing this move is sustainable. It's not pump and dump, it's institutional accumulation.
$8.37 is a key resistance zone. The 24-hour high is $8.39, breaking that requires sustained volume. Currently, the relative strength against Ethereum is impressive. Chainlink is outperforming even the big movers. Technically, this is a breakout setup. If it holds above $8, the path of least resistance is higher, driven by the narrative gravity pulling it toward institutional adoption metrics.
And the sentiment around it is cooling off the fear of missing out. Everyone knows the CBDC ban is happening. The Senate bill is clear. The fear that crypto will be replaced by a government coin is gone. That removes a huge psychological weight from the altcoin market. Retail is realizing the threat is gone, so they are buying the beneficiaries. Chainlink is the prime beneficiary.
Threat removed or threat delayed. The Senate bill is a housing bill with a rider. It's not a comprehensive crypto market structure act. The midterms are looming, political winds shift, and while TD Securities likes tokenization, Core Scientific is failing. Who audits the tokenized bonds Bitfinex is issuing? If the underlying assets are flawed, the whole house of cards blows. You're betting on perfect execution in a messy political landscape. That's not investment. That's gambling.
So we have a market divided. Bitcoin is stagnant, trapped by a lack of leverage. Ethereum and Chainlink are surging on regulatory tailwinds and institutional adoption. And the broader risk environment, measured by the VIX and geopolitical tensions, is heating up. How do you synthesize this divergence, Apex?
Here is the synthesis. The buy the dip narrative applied broadly to Bitcoin is obsolete. Grid correctly identified the technical hollowness of Bitcoin at 64,000, and CIPHER confirmed the flow exit. The smart money is not defending the fortress, it is raiding the supply lines elsewhere. We are seeing a deliberate rotation into tokenization infrastructure, Chainlink, and high-efficiency L1s Ethereum, Solana that have actual usage metrics, unlike the leveraged speculations surrounding Bitcoin. Pulse noted the extreme fear, but that fear is misdirected. It's focused on Bitcoin's stagnation, while capital is happily migrating to alts. SPECTER raises valid risks about macro volatility, but those risks are currently being priced in and absorbed by the altcoin bid. The alpha is not in holding Bitcoin's spot, it is in navigating the liquidity shift toward compliant, yield-generating infrastructure. The market is telling us that Bitcoin's era of easy leverage is over, and the new era is built on utility.
Final takeaway for London: ignore the Bitcoin stagnation. The action is in the rotation. Ethereum and Chainlink are leading the charge, backed by tangible institutional flow. The fear index is low, but the volume is high. Capital is finding a home in the infrastructure layer. Keep an eye on the Ethereum/Ethereum pair ratio for signs of continued strength, and watch Chainlink break through that $8 threshold. If it holds, the tokenization narrative is secure. If it fails, the rotation stalls. That's your map for today. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.